Good afternoon, everyone. My name is Hany Awadalla. I'm the head of investment banking at LifeSci Capital, and we are delighted to be discussing today for all of you at the Sachs ELSF Biotech conference, the biotech capital markets. Next slide. Just to frame this out and put it into a little bit of a historical context, the last 2 years have really been quite dramatic for a variety of reasons that I think our panel will touch on with respect to at least the IPO market in biotech. The interesting thing, I think, if you take a historical view, is coming out of each year from 2016 through 2017, very strong positive returns on the classes of those IPOs. There was, in 2018, there was a contraction. There were negative returns for that class. And as a consequence, you saw a pretty significant drop between the number of IPOs between 2018 and 2019. There was, in fact, a 26% drop as a function, in large part, of the negative returns in the prior year's class. In 2019, in a very selective market, the returns came back. And then obviously, the interesting thing is they came back in full force in 2020, with that class ending with almost 100% gain over the full year, only to come crashing down really in 2021. The interesting thing, I think, is if you look back and you see where all of those classes are trading today, the median return of every class other than 2017 is now negative. 2021 has suffered most dramatically, with that performance having a negative 33% median return and a mean of negative 24%. Record dollar volumes were raised, almost $29 billion raised in 2020 and 21 collectively, versus only less than $5 billion raised in 2019. And so I think with that format, with that in mind, next slide. What you can see here is, and this just gives you a general distribution of how bad the class of 21 is performing and what that really means, I think, going forward. But if you look at this, there are, and this was actually done at the end of last year, the numbers are actually worse now. But, as of the end of last year, only 18% of companies that went public in 2021 had positive returns. And in fact, 41% of the IPOs that went out last year had returns of negative 40 or lower, which is very, very dramatic given the dollar volumes raised. That is a significant loss of value in the market, and we're going to discuss the implications of that as we look forward. Next slide. Where we are today, and this just tracks, from the beginning of 2021, the three major indices, the NBI, the NYSE ARCA Biotech Index, and the European Pharma Biotech Index. Interestingly, the only positive one is the European index, but keep in mind, these negative returns include all of the major, both revenue generating as well as clinical development stage biotech companies, from large to small. And so in part, this drop really masks the impacts on smaller biotechs, which are the ones that we typically deal most often with. And those returns are significantly worse since the beginning of 2021. Next. So I just wanted to frame this out with respect to looking at the US biotech markets, and we are going to look at the European markets as well. But what you can see here is for IPOs done greater than $50 million, which are a lot of the ones that we tend to deal with. What you can see here is that there has been quite a dramatic drop in the deal size between 2021 leading into 2022. There's been about a 20% drop in the average dollar amount raised. And I think more importantly is when we look at the pre-IPO valuations, there's been a very dramatic drop, a 31% drop in the average pre-IPO valuation. And really what that drop means, there's a slightly less significant drop in the medians, but what that really means is the top of that market has really come off. We only have 4 data points in 2022. I think it's important to note that while the vast majority of companies that went public in 2020 and 2021 were preclinical and phase 1, the 4 IPOs that have come out since the beginning of 2022 have all been clinical stage development companies. None, by the way, have been oncology, which has tended to be the most significant factor in the IPO market in prior years. I think if you look to the bottom left, what you can see here is, and this is what I referred to earlier, the positive aftermarket performance are the number of companies that have come out in each of those classes that are above issue. And so what you can see here is in 2020, there are only 23% of the 69 IPOs that are currently trading above issue. In 2021, that's even more dismal, with about 14% of that 79 of the 79 IPOs that are currently above market. Above issue. Next. And so with that framing, I wanted to introduce the panel that we're going to be talking about all these factors and what it means and the implications for companies in Europe that are thinking about accessing the capital markets, both private and public. I wanted to introduce Jan de Kerpel. He's the co-head of corporate finance at Kempen. Nicolaus, who is a managing director of healthcare investment banking at Stifel. Michael Margolis, senior managing director and co-head of investment banking at Oppenheimer. And Gabe Cavazos, senior managing director of biotech investment banking at SVB Leerink. Gentlemen, it's so nice to have you, and welcome to the panel.
Thank you, Hany.
So, Jan, I wanted to start with you, and what I wanted to do was really talk about some of the Euro-specific issues, and then move broadly to looking at the broader capital markets involving the U.S., the NASDAQ, and the NYSE as well. Interestingly, while we see a lot of robust activity in the European life science company formation front as a result of growing private pools of capital, we haven't seen the same in the public markets in Europe. And I'm just wondering if you would comment on that.
Yeah, indeed. I would say the European ecosystem is not as developed, not as mature as the US ecosystem when it comes to biotech life sciences company, but there's definitely a wave going on getting to that level. And there are a couple of things that are very important over there. First of all, there's the examples of the success stories. So nowadays we do have a couple of companies that are playing in Champions League, in the primary league. Think of Genmab, think obviously of Biotech, and what do you have? So these examples show to companies and investors that the route to the public market is one that can fund very ambitious plans. So we are getting there. We're not yet there. The other thing is that historically, many companies that wanted to go public, life science companies, biotech companies, thought that they had to go to a local market, and local really means a Swedish company going to a Swedish stock exchange, a French company going to Paris, and what do you have? And that's absolutely not a unified market versus, for instance, what NASDAQ or New York Stock Exchange is. So it's much smaller geographically in itself. Luckily, we see over the last couple of years that those companies have found their way now to NASDAQ, but not enough. So we still see some local hero effect that is still playing, and especially it's the board, the shareholders that sometimes dominate that local thought and not that global thought. What we do see is that companies that have ambitious business plans, operational plans, and especially developing therapeutics platform companies, there you see that the vast majority that go public they go to Nasdaq. Okay? There were several companies last year. Let's just name a few European companies: Achilles Therapeutics, Pharvaris, Lava Therapeutics, early stage companies, but they found their way thanks to their shareholdership, thanks to their crossover rounds that went to Nasdaq, just like any, I would say, US biotech company at that stage. So for me, it's in summary, we're ramping up, we're thinking global, and we're getting ambitious thanks to some success stories that we've recently seen in a nutshell.
But it sounds like that migration from local markets to the NASDAQ or to US markets, in some ways, I think, negatively impacts the ability of those markets to be able to retain both capital and the companies themselves. Is that in part because the European, there hasn't been a rise of sort of life science specific public company funds that provide deeper pools of capital once a company is public? I'm just trying to understand why companies feel the need to migrate.
Partially yes, partially no. I would say in certain jurisdictions, and let's take, for instance, the Swedish market. It's an enormously vibrant market over there. There's an enormous amount of all kind of individuals, organizations, pension funds that invest in these kind of companies. So it's quote unquote relatively easy for such companies to go public, either through listings on, I would say, mini markets, so where you don't have a lot of regulation, you don't raise a lot of money, but you're public. But if you compare it then to other jurisdictions, let's say the Netherlands, while there are very sophisticated investors in the Netherlands, or Germany, there you don't see that local ecosystem being so supportive to go on the local market. And then you see that many of those companies go directly to Nasdaq. In France, for instance, historically, there was a lot of local money, unsophisticated money that invested in these companies, and especially if the deals were small. So it's all about, am I ambitious? Do I need a large amount of money to fulfill my business plan? Let's say $7,500 million US. It's very clear that then you should actually go to the US. But if it's smaller amounts of money, then maybe you can survive on the local stock exchange. So for me, it's more about easy money available locally that pushes certain companies and certain jurisdictions on a vibrant local market, some success stories. But it's not about sophisticated big funds in Europe or the US that don't find their way to those European companies. Those funds find their way, but maybe the companies are not always ambitious enough to attract that money.
Got it. And what factors should, and does anyone have any other comments on Jan's commentary?
Yeah, Hany, I agree with everything Jan has said. I mean, I think, just the overarching point is it's never been in doubt that UK and European science has been world-class. And, if you want a little snapshot, a vignette of that, I think the fact that 2 of the 3 leading COVID vaccines came out of the UK and Germany is a great example of that.
I'd also argue historically, US funds did find their way, as you said, Jan, to Europe. BVF is one example, but others that looking for that pricing arbitrage between the US and ex-US opportunities, whether it's Scandinavia, whether it's Central Europe, whether it's UK. It's been a feeding ground for US funds historically. Although right now there's bargains everywhere, both in the US and ex-US, but certainly was an opportunity given the strong science coming out of Europe and the UK.
So Jan, in thinking about private European companies, as they think about their alternatives for getting public, what should companies think about as they contemplate a listing on either a local market versus going directly to the US market, as you mentioned previously?
Yeah, a couple of thoughts here from our discussions that we have over the years with companies. If you need a large pool of capital because you are, for instance, a therapeutic platform that is early clinical stage, and when you become successful, you will have to have more money. It's typically the route of argenics. you make sure that you are on a NASDAQ listing before your big event, phase 2 clinical data comes out, because the big amount of money for that, you need to be on NASDAQ and you need to be there already. So your IPO should not be your biggest fundraise that you're going to do. If you are a medtech company, if you're a diagnostics company that needs a couple of tens of millions of dollars, and you're not a serial fundraiser, you may be happy on a local stock exchange. But what I also see is that companies should really plan really ahead, years and years upfront, on going to the bigger platforms. And the example that I want to use here is this Belgian company called Itios Therapeutics. Fantastic success. But there you saw that already in 2018, the CEO and the management team were already through onboarding sophisticated US investors in the private company. I believe it was a Series B when MPM Capital joined, $80 million fund. That it was a whole trajectory of that company to eventually 2-3 years later end up with a very successful NASDAQ IPO. And I think that a lot of European companies, because of their boards, because of their local shareholdership, underestimate how their journey looks like. And they think 1 or 2 meetings with some very sophisticated guys, even if they are friendly and know the European ecosystem, it's really not enough. So start early on with your journey, 2 steps at a time, thinking ahead of whatever you do, and have the ambitious operational plan. That capital can be used and can be raised for that plan, and not the other way around. Not like I can only raise 40 million, thus I'm going to a local stock exchange, thus I'm only going to do 1 or 2 programs. Really think the other way around. And that's a mentality, maybe for some Europeans, and I invite maybe Nick to comment on that as well, that we sometimes don't think big enough versus many US-focused companies.
Yeah, look, I agree with everything that you said. But look, capital is becoming more and more international all the time. Seeing those funds, come over to Europe, they're certainly not averse to coming over here and investing. But yeah, sometimes management teams aren't quite ambitious enough. But I think it's collectively our job as advisors to spot the great science and encourage that ambition.
Nick, I'm going to go to you. So for companies that are already public on a local exchange, in your view, what's the right timing to think about listing in the US? Jan alluded to that a little bit. And then what happens when potentially, as a result of maybe some of the inefficiencies in the local market, there are sort of a valuation disconnect between markets? How do companies deal with that?
Yeah, so look, I think the timing of any IPO, or in particular dual listing, is always sort of the $1 million question, right? And getting that right is important. I think what we've learned over the last several years, and particularly during the pandemic, is the so-called crossover round concept is effectively mandatory for companies wanting to go to NASDAQ, which in a way makes it a little bit easier to determine the right timing, because it's very much a sort of, I guess, a more extended routine of dance steps between companies and investors in the US, if you like. The vast majority of NASDAQ IPOs now have a crossover round in place. And, there's a well-trodden path to putting those crossover rounds in place for companies with a listing on a local exchange. So that really helps to de-risk the dual listing. A dual listing is oftentimes a slightly riskier undertaking than simply a private company out of Europe going to NASDAQ, because to do the test the waters exercise, you have to put out the so-called Rule 135 announcement to allow the test the water meetings to take place without wall-crossing investors in the US. So, the company is effectively press releasing that they're looking to do a US IPO. And if they don't consummate a transaction within 4, 5, 6 months, the market will sort of smell a so-called failed IPO, and that typically has a negative effect on the share price in Europe or the UK. So it's not risk-free. So you want to explore that path very carefully, particularly when markets are more choppy before you break cover. I think just to get down to some of the more sort of prosaic elements, as you highlighted up front with that great review of the data. Hany, US IPOs have been getting bigger, particularly during the pandemic. People have been wanting to allocate more capital to individual situations. Crossovers have been getting bigger. IPOs have been getting bigger. I think the so-called, sort of pro forma $75 million IPO that's almost on the small end now. I think people are much more thinking about $100 million situations plus. So therefore, if you're listed in Europe and you've got a market cap of $80 million and you're going out to try to raise 80, that feels quite top heavy just in terms of basic maths. And it's oftentimes challenging to get a shareholder vote through to raise that amount of capital. So I think, you're probably looking at having a market cap of at least $200 million if you're wanting to go out and raise 100 in the US in a dual listing construct, and oftentimes north of that. So just a very brief overview of some of the key dimensions, but maybe the other panelists have got some comments to add.
And Nick, I would agree. It's challenging. Timing is everything. There's obviously a reference price. There are public peers in the U.S. that are trading that everyone's looking at as a reference point as well. I think that your point about being perhaps too small from a market cap perspective is important. Conversely, if you've got a very supportive shareholder base that frankly they're very sticky and they're going to stand by you, and you haven't seen some of the stock price deterioration that your U.S. public peers have seen, then U.S. investors could feel like you're overvalued on a relative basis relative to your peers, and that could also be challenging. So thereby looking for perhaps a bigger discount than the local jurisdiction would allow, or just generally a deal that's untenable relative to what would otherwise in a normalized market be acceptable. So it is challenging. Timing's everything. You'd like to see a market that's stable, not volatile because of that reference price, and try to get in and out of the market as quickly as you can.
And Gabe, I agree with everything you just said. One thing I want to bring up is delisting of the kind of the home market. I think it's a question that we get asked all the time. And one of the first deals that I worked on ex-US was for an Israeli company. And I remember management and the board coming to us asking for a premium to their currently traded stock price on the TASE. I was probably a bit naive back then. And of course, I'm like, sure, no problem. Of course, my capital markets people wanted to have my head on a platter for even offering up that idea. And of course, the company never were able to do a premium deal to their TASE-listed stock price. I think that's an important point too, being realistic. Like I think the market obviously now is more challenging, but even over the last couple of years, we never really saw a premium deal to the local markets. And I'd love to get Jan and Nick's thoughts on, and I think this is important for the audience, perhaps, delisting at some point from the home market. There's always a challenge with dual listed stocks, especially if you do an ADR and ADS program, you get liquidity issues, which is never easy. It's probably easy to buy the ordinary shares and buy the ADRs or the ADSs.
Yeah, I would love to share some thoughts on that, because indeed we get it nowadays also. Before, it was actually never a question, should we delist our company from the Belgian or the Dutch or the French stock exchange, and now we get it. If you do the analysis, you will see that netto your liquidity has increased if you have a dual listing, but the liquidity is usually always sitting in one spot. And most of the time it is actually sitting in Europe. There are only a few companies that are dual listed, Europe, NASDAQ, that have a bigger liquidity sitting in the US. It does not matter. A US specialist investor doesn't care where the liquidity is sitting as long as there is liquidity. They are happy to turn the ADRs into shares or the other way around. It's not expensive. It's easy to do. We actually take the view that there is nothing but benefit to have the dual listing, because at certain moment in times, US investors will love certain stocks and they will all think the same and go and sit in the NASDAQ listing. But at a certain moment in time, and especially when things go sour or are perceived to go sour, you may actually be very happy that you still have a local shareholder base that can pick up some shares when things go negative. If you take a company that, for instance, let's take ProQR in the Netherlands now recently, extremely unfortunate phase 3 results, and you see your typical NASDAQ drop of 70-80%. I don't have a crystal ball, but if that company would have had more local shareholders, Dutch or European, I think the drop could have been far less because now nobody was picking up these shares in the local market. So you are nobody in the US because you're a European company, and you're nobody in Europe because you're Nasdaq listed. And that's where the dual listed, at least you are somebody somewhere over here.
Very interesting point. I would add a couple of things just as a prescriptive for European companies contemplating a potential IPO in the US. One thing that we've done with clients is introduce them to US investors. And what we've seen a number of times is those US investors, particularly for situations where valuations have been relatively low, take investments in the form of a PIPE. And that immediately creates visibility in the US markets, particularly if it's a very well-respected fund. And that sort of begins to lay the groundwork for a possible listing on the back of a catalyst of some sort. But I think, finding US investors in advance of a listing is absolutely critical. It can be done in the form of a crossover if you're a private company. But if you're a public company, I think thinking about bringing individual investors in a smaller syndicate in the form of a private placement, I think can be very effective. So we're going to go to lightning round because we've got 27 minutes. So why don't we focus now on the capital markets in the US and really the effect of 2020 and 2021 on some of those. So Mike, obviously unprecedented levels of activity in 2020 and 2021 in terms of capital raising relative to prior years. What were, in your view, some of the factors that led to this, and how do we look at that as we think about what's happening going forward?
No, thank you, Hany. And I've been asked this question before, and I've spoken about it over the last couple of months as well. I think you got to think about the backdrop here of the pandemic. When 2020 came around, the pandemic started in March. And I think most people thought that the U.S. capital markets, the global capital markets, would be slammed shut. I think that's for 3 or 4 weeks in March. We're all wondering, are you going to do any deals throughout 2020? And of course, April came around, the markets opened up very aggressively. I think investors realized, and this is also generalist investors, there are only a few sectors that were financeable, and that really boiled down to broadly healthcare and technology. Many of the other sectors out there just were not investable, and the generalist population out there saw that as well. I mean, I remember playing golf with friends, and they started talking about all these COVID stocks, all these biotech stocks that I knew really well that had COVID programs, and I'm thinking, oh my God, this is not gonna end well. When my friends are talking about certain stocks that were, really they were meme stocks. These stocks were just trading on a preclinical idea that could actually treat COVID. But I think that the reality is so much capital had been raised over prior years, and they funded these companies. And so about 170 companies go public over 2020 and 2021. In 2021 just being about, I know that your numbers are a little bit less than mine, but about 101 IPOs is the number that I have. And that's just not a normal number, right? It shouldn't be 5, and it probably shouldn't be 101. I think the reality is, a lot of capital out there, a lot of crossover money out there, and the valuations also got bedded up too over the course of that really of 18 months. And we've all seen kind of the impact in the capital markets, or really especially in the last 6 months. With that said, you had generalists coming in, investing in all these gene editing, cell therapy, and every really innovative sector of biotech. And certainly, I think it fed upon itself. When the reopening trade started, probably in the latter part of 2020, 2021, you lost a lot of that generalist money because they're looking to generate alpha. And you figure you can go invest in energy, you can invest in travel and airlines, and technology obviously still kind of carried some momentum. We had other sectors that were just more attractive to those investors. And therefore, I think what we were left in 2021 was a sector of specialists. And I think to me, there was a lot of air in the system. And of course, things really pulled back significantly over that period of time. Look, to me, the innovation curve in biotech and life sciences has never been better. My career, I started in big pharma back in the 90s and worked at Novartis in Europe in the 2000s. So I kind of saw the planting of those seeds. And I think to me, you got to be really careful when you fund these companies. You talked about, Hany, rounds of capital is getting Series A rounds getting larger, valuations getting larger. At the end of the day, you got to find capital to fund these companies. So yeah, you get public, and most of that money is coming from insiders. Where's the money going to come in the follow-on or the future raises? Especially these companies have some hiccups and some pullbacks, which we've seen, right? Unfortunately, most of the data and most of the regulatory news coming out over the last 6 to 12 months has been negative. And that's just part of drug development. You deal with early stage companies, especially companies that are 2 years away from the clinic. It's really hard to really pinpoint what you're buying. You're buying cool technology. You get into the clinic, all of a sudden you're in phase 1, which historically supposed to be dose ranging, and mostly, I would say it's you're evaluating a drug to see kind of which patient population is going to work best in. But we're making some significant investment decisions on phase 1 data, which is tough for the industry, right? So what do we have right now in 2022? We have a massive digestion process. To me, the technology hasn't changed, but you got to be patient. And I think we're also hoping for some of the funds out there that really have had a very tough time over the last 6 to 12 months to start investing and I would say in these companies. And right now you get this inversion in valuation where the public comps, frankly, look a lot better than some of the private companies that may have a crossover round, maybe not have a crossover round. But you got probably the 2021 class, and I don't have the percentage on it, but I would say a good number of those companies are trading below their crossover rounds before they went public. That to me, that's probably going to drive this sector again. As investors have to look at some of the opportunities that just got thrown, the baby being thrown out with the bathwater. There's some real opportunities here to invest in, and probably not sprinkle money around like it was happening in 2021, but make more concentrated bets and generate alpha and significant returns. Hopefully.
So Gabe, what do you think? Michael's laid out an interesting picture, and I think we're all on board with that. How do we look forward, and what should companies be thinking about if they're private in Europe? What do they need to think about? How do they position themselves as they look at the unfolding conditions in the market right now?
Yeah, no, Michael nailed it. I think literally every thing that he mentioned, we've seen play out. And look, I think that for many of our clients in Europe, the crossover path is still important. We've heard, frankly, investors, my banking colleagues, board members asking if that phenomenon is going to go away. It's partly responsible for the bloat that we found in the biotech tape. Doing crossovers got bigger, IPOs got bigger, step ups got bigger. Deals were pricing $1, $2 above the range and then trading up 7,500%. So everything got bigger and bloated. So if you took the crossover step out of the equation, then naturally valuations are lower, and that might attract new money. We haven't really seen anyone test that yet. I think there are banks and there are investors and their board members that are toying with that notion. But for the time being, I do think that there's still meaningful benefit to doing a crossover round for all the reasons that everyone knows. I think we're at this point in time where there's just a massive dislocation in the markets. We talk to crossover investors every day, and they're all looking at public, quote unquote, broken stocks where companies have done nothing wrong other than be public, and deploying capital in those stocks. That's a finite period of time, I suspect, and so when IPOs start going out again, and we hope that's as early as April. Assuming they're priced responsibly, they perform well, and new investors make money or start to make money, that will inherently open things up, right? So more companies going out, less private paper in portfolios and on balance sheets. So that should open up the path to more private investments. But it's quiet right now, and I think a lot of VCs are looking to preserve capital to continue to fund their private companies. So having the right VCs, supportive VCs, has never been more important, frankly. A lot of the European VCs have raised significant capital and crossover funds. So I think the European ecosystem has never been stronger. And frankly, I think, Hany, you put up the numbers in terms of the indices. Europe has been somewhat insulated for these companies that are trading on local exchanges. Many of the crossover investors in the US were kind of left holding the bag when generalist investors rotated out of the sector and they took significant pain. I don't think a lot of the European investors felt that pain in the same way. Sure, it was painful, but I think not the same magnitude. So Europe is pretty healthy. We continue to advise companies to think about a path to an IPO, but plan for a longer path, and make sure that you have the right supportive VCs around the table.
It feels to me like there's a lot of friction at the moment. I think indigestion is a good word, but I think for companies that have already done crossovers, some of that friction is lessened simply by the fact that the crossover investors will typically support the company in doing an IPO. But where I see a lot of friction is companies that raised, the round right before a crossover in 2020 or early 2021, with the presumption that a crossover was right around the corner, and suddenly they're left with valuations that are not consistent with where crossovers are going to get done, given the rate of return that a crossover investor is going to look for, and given the fact that obviously the IPO valuations have come off, and that friction, the pre-crossover round companies right now, I think, are going to face the biggest upcomings to a certain extent.
Well, Hany, if you remember, what is the purpose of a crossover, right? When crossovers were introduced, probably 2015, 2014, essentially, you buy it for the step up, right? I want a crossover, and you buy it because I couldn't get an allocation in the IPO because these deals are so hot. I better get involved in the crossover. So what we have now is that we have a reduction in step ups, right? Valuations got ahead of themselves. And there probably isn't this huge demand for IPO allocations. You want to get an allocation on an IPO, you can get it, right? Well, I'd be happy to give you any allocation you want. I'll give you 100% of what you ask for. So I think when you have a dynamic where there isn't a huge demand for IPOs, and I agree with Gabe that I expected to be IPOs later on this year. You had a couple get done. You had 3 deals get done before JP Morgan, and actually they're performing well. And there are a number, we all know the backlog, the public backlog and also the confidential backlog is significant. I think it's going to boil down to quality. I think the higher quality companies that are reasonable on valuation will have an opportunity to get out there. But I also agree that you're going to have insiders step up, whether it's a crossover or whatever. You got to have insiders step up for that IPO and have a strong shadow book.
Yeah, the interesting thing I haven't seen a capitulation on post crossover valuations yet. I've been waiting. I haven't seen it.
Yeah.
And I think in part the reason for that is because the crossover investors have, and I also haven't seen a contraction in the step up return, right? It's typically kind of 1.3 to 1.7. And I haven't, I think our Celix was done at 1.299, right? So, I mean, there hasn't been that's why I'm saying, I think that friction, I think the crossover guys will get the companies public that can get public and support themselves without the help of third-party IPO investors, right? We're not going to get the big mutual funds.
That's a really interesting point, right? Because I'm actually a little bit more worried about some of the folks that have done crossover rounds versus the guys that are sort of pre-crossover. And if you look at those 3 IPOs that came in the first week of the year, they were basically substantiated by the crossover funds, and there was not really any marginal buying on day one, and they were all flat to weak. I think we're suddenly hearing that not all of the traditional crossover funds have just got enough assets under management to stand their corner in the IPOs of the crossovers they've done, even assuming they don't get any withdrawals. So I think ultimately, these companies die of starvation, not dilution. I'm not so worried about valuation. Valuation is always fungible. You can always move that around to fund the company, provided the current shareholders are willing to do that. I think, actually some of those crossovers may actually turn out to be busted crossovers if the crossover investors can't stand their corner. Let's see. Hopefully the market turns and and those guys don't get withdrawals, and they get more funds coming in, and the market heals.
I think the interesting thing is, we saw this incredible contraction in time frame between end of crossover and IPO that was really characteristic of the end of 2020. The nice thing, I think, is, as you saw in that slide, companies are coming to an IPO with about $120, $130 million. So I do think that what we're going to see is this expansion in time frame between the end of crossover and companies that were preclinical or early stage clinical, and right now what's hot is data. And so I think those companies are going to have to just sit tight and generate some data in order to be open, in order to be able to take advantage of an IPO window that I think now is very, very narrow. So we've got 12 minutes. Let me just throw out some questions for the group. Historically, we've seen gene therapy, we've seen cell therapy be hot. What are investors looking for now in terms of hot areas? Clearly, the bulk of the bulk of IPOs in the last couple of years have been preclinical, early stage clinical, lots of oncology. What's hot going forward?
Listen, I think neuro is getting very interesting. Neuroinflammation, Tregs are hot right now. I think precision oncology is hot right now. I think you also had data. I think differentiated data, activity, and durability of that data is so important. I think you see a lot of companies, especially in the cell therapy space and the IO space, they're in phase, and there's a problem of phase one. You have a couple PRs, it's encouraging. The durability is unknown at this point. And then all of a sudden you're in cell therapy, you got cost of goods challenges, supply, you got a lot of other challenges to deal with that are expensive. They don't get worked out until, frankly, later on in clinical trials.
So later stage data. Gabe, what do you think?
Yeah, no, I would agree. I mean, I think precision oncology, and AI, machine learning, back precision oncology companies, precision medicine in general, so precision IBD, CNS, kind of going after more targeted patient populations, segmented in a way to where you're going to, increase the likelihood of success based on the either the genetic profile or the biomarker strategy. Targeted protein degradation, obviously, still very, very hot, and I would agree in the Treg space as well. I've seen a lot of funding. The RNA editing space as well is another one.
I'll throw out one concept which I think is changing. Historically, drug discovery was all chemistry. My family worked in the pharmaceutical industry for almost 50 years. I'm a pharmacist by training, and I was brought up on chemistry. Biology was just obviously most of the work that we've seen is all about biology. I'm seeing companies, especially in precision oncology, going back to chemistry, old-fashioned drug discovery, and kind of what's old is new again. And I think that's exciting as well.
I mean, one of my ambitions for the market going forward, and I say this having a very low probability of this actually happening, is that maybe we can get off sort of an obsessive trend around a thematic. We've just seen this movie way too many times. Like, everybody charges into immuno-oncology, and then people realize that's got massively overbid. We have a few bad data events, and everybody charges for the exit. We've seen the same in cell and gene therapy. It's a pretty unhelpful trend that the tide is either fully in or fully out in these therapeutic areas and subsectors. I think people just need to go back to basics, look at the data, look at the durability of response, look at the market opportunity. Is there a credible commercial opportunity? And maybe be a little bit less blinkered and just rather than just following what everybody else is doing. I think it's very unlikely that happens, by the way.
Great. I guess one other topic that Jan had wanted to bring up: SPACs. 2 minutes on SPACs.
Yeah, I just we all noticed that there is an enormous amount of SPAC money raised in 2020, early 2021. They have 2 years to find a target. So that means second half of 2022, first half of 2023. All of that SPAC money needs to come to the market. Yet what we see today is that the SPACs also need to have a pipe linked to it. And that's exactly the discussion that Mike and Gabe gave before on the crossover aspect. Crossovers are not working, so the pipe is not working on the SPAC. So I just wanted to raise the thought here. Are we going to see 100% redemptions in all these SPACs, or are some going to survive? So it's more a question to the broader group. My thought is it will be like always, a lot of redemptions and a lot of zero redemptions, and the average will be 50, but there will be two groups. So that's my thought.
I think that's right. I think it's pretty binary. And I know Gabe, Hany, and myself, we all been involved with SPACs. I think obviously the trend lately has not been great. It's all about the pipe. It's all about the story. It's all about valuation. I think there are a number of companies and targets going through the de-SPAC process, chose a SPAC over a plain vanilla IPO because of a higher valuation. I'm not sure which banker told them that was reality, but once you start trading on NASDAQ, gravity sets in and you get, you're in the same boat as every other public company. And I think that's just a real mistake. And you had a lot of, I would say, unsophisticated people in the SPAC space that try to kind of take advantage of all momentum. Like everything else, I think the pendulum is shifting now. It's all extremes. It is moderating. I think, Gabe, you've done reverse mergers, you've done other alternative public offerings. I do see SPACs being an opportunity for companies. I think, but it really is about the pipe. You got to get the pipe done. If you can't garner strong healthcare interest, I think you're gonna have a real tough time getting it done.
That's absolutely right. I think, companies have to come with their own money. And if a company can't come with its own sponsorship, there is no alternative that just simply finds cash parked on the sidewalk that allows a company to access any pool of capital. So I think companies have to spend a lot of time cultivating investors to believe in their story and their narrative for any of these opportunities, whether it's a traditional IPO, whether it's an alternative IPO path. You've got to have your own set of investors. You've got to have your own set of sponsors. Let me just turn it over, Valentin. I don't know quite how the Q&A works. If there's any questions in the last 6 minutes. No questions. We've answered everyone's questions. All right. Terrific. Any other comments?
Yeah, I'll add one comment about the SPAC and reverse merger process. It's still a viable path, right? I mean, I think I get this question more often in this market than not, given that the path to a crossover seems, not just arduous, but impossible in this market. And the IPO market looks like the window is not going to be open, meaningfully open for some time. I get the question all the time: should we consider these deals? And the answer is absolutely. I think if you have strong investor backing and you have, to your point, Hany, you have capital behind the company, then you should certainly consider it. And I do think that the outcome is somewhat binary, where not all SPACs are created equally. And I think that finding the right valuation is incredibly important to get to bring new investors in. But it's a viable path. We continue to believe in that path, and we're frankly we've never been busier on that front, and the reverse merger path as well. If it's a clean shell with enough capital coupled with the cash on your balance sheet and perhaps a handful of new investors that can fund your business for a couple of years through meaningful value inflection points, absolutely lean into that transaction in this market. It's a viable path to the NASDAQ.
I'd even offer up to European companies who are looking at getting a foothold in the U.S., getting on NASDAQ, getting on New York Stock Exchange. I think now, just given the demise, and especially in the microcap and small cap space, look at business combinations. I mean, I think looking at figure ways 1 + 1, hopefully equals 2 or more. I mean, essentially it's a reverse merger, but it may not be. It may be 2 companies that have complementary pipelines. You can get some synergies there. You get access in the U.S. Maybe you gain some management and board capabilities that could be well received here in the U.S. with U.S. investors or broader investor base. We're seeing that a lot. I'm sure, Gabe, you're seeing the same thing on your end, where companies are just getting creative. And I think what generally happens is, as you see a prolonged period of lower valuations, companies realize they're not going back to where they were last February. Their access to capital is not the same. And it's a bit of a digestion process, a mental digestion process on their end, both for companies and boards.
I'm not sure companies have crossed that bridge yet.
They haven't, Hany. They're not there yet. No. It takes time. And I'll tell you what, one of the first questions on the J&J earnings call was do you expect to see a significant amount of biotech M&A given the decreased valuations? And the response was, we haven't seen it. We haven't seen a long enough period of prolonged downward valuations. It takes time. We saw this in the early 2000s, especially. It just took time.
But also on M&A, I mean, it's more about any serious company looks at what am I buying, and then afterwards takes a look at what's the price. It's not because it's cheap that a big pharma company is going to buy something. It's the other way around, is the quality there. Well, maybe one thing on the spot things that I wanted to share is that we see a lot of non-educational board members on these SPAC things. They see it as a strange thing that they shouldn't involve in. They are afraid of it. They think of it's more dilutive or it's more negative, which it absolutely isn't. It's just another way of getting your company funded and to the Nasdaq. It's not the one or the other. It's just different trajectories to funding and to a diversified shareholdership. I don't know if the other panelists also feel it like that, but there's some education to be done in my opinion.
I think people have to be careful. I mean, there's lots of different flavors of SPACs. So I think companies just need to go in with their eyes open, understand the bells and whistles that could in fact create additional dilution. But I agree with you. I think the change in what I've seen over the last year and a half is what we thought were traditional kind of institutional SPACs that would be able to retain capital are just as, they're seeing redemptions at very similar levels to any of the other kind of non-institutional SPACs. And so again, you can't rely on that pool of capital at close. You've got to be able to bring your own capital to the closing as well. Terrific. Gabe, Jan, Mike, Nick, thank you very much for participating on this panel. Thank you for Sachs hosting this, and I hope it was informative to all of our listeners.